sound risk management, first of all, importantly, is not risk avoidance. Risk avoidance usually results in return avoidance.
Yeah.
If you want to make a good return, you have to take risk. I put out a memo last week on the subject, and I said, if you want to make money, you have to take risk, but you should not expect to make money just for taking risk. You have to do it skillfully. So there is a process that I call the intelligent bearing of risk for profit, and that we try to engage in that. It has to be risk you're aware of, risk you can analyze, risk you can diversify, and risk you're highly paid to take. Mm-hmm. If those four necessities are satisfied, then it pays to take risk.
When you talk about probabilistic outcomes, what do you mean by that?
Because we're not dealing with the physical sciences, because we're not dealing with physics, there can always be a variety of outcomes. The future is never so certain that only one thing can happen. In fact, there was a professor at the London Business School named Elroy Dimson, and he said, risk means more things can happen than will happen. Mm-hmm. It's a very simple statement, but it's very true. And so you have to appreciate the fact that under any set of circumstances, a variety of outcomes are possible. And you should always allow for the vagaries of the future. Mark Twain, the great American humorist, once said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." In other words, excessive certainty is the enemy. Acknowledging your limitations is your friend. It keeps you from getting into trouble. I've always resisted having a risk management department. I think it's everybody's job to control risk. And the person who advocates for a given investment and studies it should be the person who not only thinks about the return, but also the risk. And the concept that I am the investor, my job is to make money, I think about the upside. There's somebody who sits over there in the corner, his job is to think about the risk. I think that gets you into dangerous territory because everybody says, well, I can count on somebody else to limit the risk. I think that's not a good idea. I think that risk control is everybody's responsibility. And in fact, I listed our investment philosophy before. Risk control is number one. And by the way, Oaktree and I and my colleagues started off doing straight fixed income. When you buy bonds, you buy an 8% bond. In the long run, the best you can do is 8%. Yeah. There's no upside. There's only downside. So the proper fixed income investor has to think about and avoid the downside. Doesn't have to worry about the upside. Graham and Dodd in the Bible of Security Analysis, well, the title of the book is Security Analysis. Ben Graham was Warren Buffett's teacher. They said in that book that fixed income investing is a negative art, that the art is in avoiding the downside, not in capturing the upside. There is no upside in fixed income investing beyond the promised return.
So when bonds had negative rates, what did you think then?
I thought it was unsustainable. But negative rates were not a market phenomenon. They were administered by the central banks. Yeah. And of course, in the short run, the central banks can do what they want. There's an old saying in America, don't fight the Fed. And by the way, if you think about it, in December, I mentioned that the consensus was that there would be 6 rate cuts. The dot plot, which is the expression of the Fed executives' opinions, said there would be 3. Now, what sense does it make for market participants to say there will be 6 cuts if the Fed itself is saying there will be 3? So I think that.
So how do you read that?
Well, I think that was a mistake. Yeah. I think that was an excess of optimism. But because risk control is job one, in my opinion, because we started off as straight fixed income investors, we came up with the motto for Oaktree: if we avoid the losers, the winners take care of themselves.
Yeah. Yeah.
Now, that was good for the first 10 plus years. After that, we started getting into what I call aspirational strategies, where we're trying to make not 8%, but 15 or 20. Avoiding the losers is not enough in that case. You have to actually find some winners. But we have kept risk control as tenet number one of the investment philosophy, because we do think it's extremely important. And I want every analyst and portfolio manager to be thinking about risk and not counting on the person in the risk department to do so.